We're now going to shift our focus to the income statement. The income statement reports a company's net profit or net loss for a given accounting period. That makes it one of the primary tools that users rely on to assess a company's performance. Now let's focus on this phrase, for the year ending or during a period. The balance sheet tells us what a company has and owes as of a specific point in time, but the income statement is different. It tells a story about activity during a specific quarter or year. It helps us answer questions like, did the company generate a profit? What did it earn from customers? What cost did it incur? And what other gains or losses affected the final result? When investors and creditors want to evaluate how well a company is doing, the income statement is often one of the first places they look. It gives them measures of profitability, and those measures can help them think about the future. Strong revenue growth, solid margins, and consistent income may tell users something positive. Declining revenues or repeated losses tell a different story. You may also hear the income statement called the statement of operations, the profit and loss statement or P&L, or the statement of earnings. This terminology can vary, but the basic idea is the same. This statement summarizes financial performance for a period. Now, the income statement reports revenues, expenses, gains, and losses. So let's start with revenues and expenses. Revenues are inflows of resources that result from providing goods or services to customers. Typically, this is either cash or accounts receivable. If a company sells products or provides services, the amounts earned from those activities are typically reported as revenue. Expenses are the outflows or using up of resources incurred while generating revenue. In plain language, expenses are the costs of running the business, and specifically, these are the core operational costs, activities that follow the normal course of the business's operations. Now, this connects directly to accrual accounting. Under accrual accounting, we do not wait for cash to be received before recognizing revenue. And we do not wait for cash to be paid before recognizing expenses. Revenue is recognized when it is earned, and expenses are recognized when they are incurred. That is a major reason why the income statement is useful. It provides more informative measures about a company's performance for the period, not just cash movement. In addition to revenues and expenses, the income statement also includes gains and losses. Formally defined, gains and losses are increases or decreases in equity from transactions that are not classified as revenues or expenses and that do not involve owners. Now, that definition, it can sound pretty abstract. So let's make it more concrete with some examples here. Suppose a company owns a delivery truck. The truck is used in the business, but selling trucks is not the company's main activity. If the company sells the truck for more than its recorded book value, it would report a gain. If it sells the truck for less than the book value, a loss will be reported. Gains and losses can also arise from changes in the fair value of certain assets and liabilities. The key point here, gains and losses do affect net income, but they're not the same thing as the main revenue and expense activities of the company. So that brings us to another important distinction. Operating items versus non-operating items. Operating income includes items directly related to the primary revenue-generating activities of the company. For a retailer, that would generally include sales revenue and cost of goods sold, along with selling, general, and administrative expenses. For a service company, operating items might include service revenue and the cost needed to provide those services. Non-operating items are not directly related to the company's primary activities. Common examples here would include gains and losses, and also interest and income tax expense. Users often want to know how profitable the core business is. If a company reports high net income because it sold a building at a large gain, that might be good news for one period, but it does not necessarily mean that normal operations are highly profitable. Separating operating and non-operating items on the income statement can help users evaluate earnings quality. Now let's talk about presentation. The codification actually gives companies considerable discretion in how they present income from continuing operations. That means that income statements do not all look exactly the same. Even so, we're going to consider two general formats that we often discuss: the single-step income statement and a multi-step income statement. The single step is relatively simple. It presents revenues and gains first, then it groups expenses and losses together. The company then subtracts total expenses and losses from total revenue and gains to arrive at net income. A multi-step income statement includes several intermediate subtotals. These subtotals are useful because they separate operating performance from other items and provide additional measures of profitability. So like I said, companies do have some discretion in how they present these. We're going to consider these two approaches as two extremes where most companies fall somewhere in the middle. Let's first look at an example of a single-step income statement approach. As mentioned before, total revenues and gains are added together. Then total expenses and losses are added together. The single-step income statement now gets its name because there's essentially one primary step to arrive at net income. These expenses and losses are deducted from revenues to get to net income. Now, the advantage of this format is its simplicity. It is straightforward and easy to follow. A user can quickly see total inflows, total outflows, and the final bottom line. The major limitation is that it provides less detail about different levels of profitability. The multi-step income statement provides more structure and more intermediate calculations. The first important subtotal we'll look at here is gross profit. Gross profit highlights the relationship between sales revenue and cost of goods sold. It helps users understand how much profit remains after simply covering the cost of the inventory or the goods sold to customers. Another important subtotal is operating income. Operating income measures profitability from normal operations before considering items like interest and taxes and other non-operating items. Income before taxes allows users to compare profitability before considering income tax effects. And then finally, net income reflects bottom line profitability after all revenues, expenses, gains, and losses have all been considered. Now, the income statement, it's not just a list of numbers. Net income is important, but the path to net income is also important. A company with strong operating income looks different from a company whose net income depends heavily on unusual one-time gains. The format and subtotals help us see that difference.